This video will give you a broad buying strategy for stock which we follow. Buy good stocks, but be sure at what valuation you are buying. All the successful investors have two things in common. They are extremely disciplined and they understand the downside of their investment even more than the upside. That is what we also follow. They look down before they look up. This look down before you look up is a phrase which was articulated by Steven Scruggs, a portfolio manager. We just follow this very, very consistently and on a daily basis. The phrase is so brilliantly simple. Of course, other famous investors have similar things in different, language, different ways, but they mean the same. Warren Buffett said, investing is all about protecting your downside. The upside will take care of itself. And he also says, price is my due diligence. Most investors forget about the valuation in bull market. All they see is more upside to justify paying up. Yes, there are AI stocks, bitcoins, and certain hot themes like railway and defense, which have outperformed in the last few years. But nothing is more toxic than watching the other investors outperform you in things you don't like or believe in. But the valuation is like a great balance sheet. Eventually, it matters. In extreme cases, a great business can't even save you from a bad entry price. P multiple expansion is a beautiful thing when you buy before the multiple expands. No one wants to wait for years and decades together to be right in some cases. It is better to buy companies before the multiple expands, before they are discovered by institutions. This is what we do and follow. Before they are priced for perfection and before there are initiating coverage reports about the company. By the time everyone calls it a great business, the exceptional returns are usually in the rearview mirror. The time to buy is when a company is misunderstood, undiscovered, and underappreciated. You essentially want to find uncrowded trades, and your entry price matters. Valuation matters. When you buy at a low valuation, it provides a better base to grow from. You don't need as much to go right to make money. If you want to find good businesses trading at low multiples, you will be focused on unknown or unloved stocks. The intersection of unknown and unloved means a microcap stock or a small cap stock. The next big winner is a company that is quietly executing under radar that most investors don't know about it or believe in. Many misinterpret investing in microcaps as a risky bet. It can be if you don't care about the valuation and profitability. 87% of the 10 baggers in global equity markets started off as microcaps and were profitable. Multi-bagger investing would be best described as getting a good entry price or a valuation on a small business that can consistently grow revenues and earnings with limited dilution. Depending on the industry, companies are valued on enterprise value, sales multiple, price earning multiple, EBITDA multiple, or price to book, or some variant of each. To find a 10 bagger, first find a stock that can double in 3 years with conservative fundamental assumptions and no multiple expansion. It can double in 3 years, meaning the business should double in 3 years. Now, what is the key to this? For a stock to double in 3 years, you need 25% to 30% annual organic growth in the denominator of the valuation metric used with little dilution. Companies organically growing sales at 25-30%, is cash flow positive, is confident that the current growth rate will continue. It doesn't need to raise money to achieve all of this and is trading at the lower end of valuation. These are very good combinations. The equity return should at least match the organic growth rate over a 3-year period, which is 100% in 3 years. Now, if the multiple expands, it supercharges the IRR. If the multiple expands to say 2x, 2 times, at the end of the third year, it is a 300% return in 3 years because 100% is the return of the earnings. Then all your peers will pile in after it triples and call it a wonderful business. A solid foundation is buying at a low valuation. Your purchase price matters, valuation matters. When you combine low valuation with a double-digit organic growth and a company that doesn't need to raise money, you get market-beating returns. Peter Lynch, in the famous book One Upon Wall Street, said that, quote, "These are among my favorite investments. Small, aggressive new enterprises that grow 20 to 25% a year. If you choose wisely, this is the land of the 10 to 40 baggers and even 200 baggers. With a small portfolio, one or two of these can make a career. This is what Peter Lynch said, and this is what we are also following in our investment journey.